Now we are joined by Daniel McDonagh. He is a portfolio manager at Perfect International. They manage the Nedgroup Investments Global Cautious Fund. Perfect employ a quality and value-driven absolute return approach in managing the fund. It has a maximum equity exposure of 40% and aims to provide a stable stream of real returns for investors. Hi, Daniel. How have you been?
All well, thank you. How are you?
Yeah, all good, thanks. And thanks so much for joining us. I hope you had a good start to the new year.
It was very good. Appreciate the opportunity to speak to you all.
Brilliant, brilliant. Dan, just wanted to get some updates from you for all of our clients dialing in today. Shall we kick off?
Absolutely, absolutely.
Okay, thanks. So the first one is just about if you can please begin by talking about the fund's returns over the past year, so 2024 as a year, and importantly, what drove those returns, please?
Yeah, absolutely. So I guess the headline figure is that the fund was up nearly 3% on the year, and the real standout feature of the market over the last 12 months has been the strength of US equities, and they finished the calendar year up over 20% for the second year in succession. And that's highly unusual in a historical context. I suppose part of that was driven by the enthusiasm for the consequences for growth of a Trump victory, but it was a very strong market, and that really dominated the returns, did the heavy lifting. Against that backdrop, the US equities of the fund didn't keep pace with the wider market. So clearly the Magnificent Seven again led the market higher. And those growth names don't suit our value approach to investing particularly well. However, the non-US equities, both the US bonds and overseas bonds, they all perform better than the indicative indices that they're measured against. A key factor of note, I guess, was the US dollar strength, particularly in the last quarter of the year. So the dollar had a stellar quarter. Sterling, the Swiss franc, euro, that depreciated by about 7% over the Q4. Japan, the yen weakened by nearly 10%, and the Aussie dollar by a huge 12%. So there were quite serious moves in the currency market, and of course that drags down the US dollar returns of those non-US markets in both bonds and equities. So it turned positive local currency equity market returns in Q4 into a negative US dollar return in places like Japan and Canada. We did have the Aussie dollar portion of the fund hedged. That benefited returns over the year, so that was a positive. And just wrapping up for the year, bond markets really oscillated between whether inflation had been defeated or not, finding it hard to make up their minds and what that would mean for the consequences for interest rates. But our low duration positioning throughout the year worked pretty well, produced returns that beat those indicative indices in both the US and the non-US arena.
And Dan, you and your team, typically wouldn't invest outside of the government bond space. Would you say it's worth venturing into more risky bonds at this point?
Yeah, it's a good question. We have a slide there on the corporate credit spreads versus treasuries, which we probably refer to now. The answer is that things look a little unattractive to us in that corporate arena. If we look at what the chart shows us, it really saying that there's an air of tranquility in this part of the bond market. The spread of high yield or non-investment grade bonds to US treasuries has fallen over 2024, and you can see from that longer term graph, it's bumping along at levels near the lows of the last 20 years. And I suppose that's a signal that lending to riskier borrowers is not really causing concerns at the moment. And because of that, you're not getting paid for that. Overall, that relaxed picture, is it relaxed or is it actually complacent? But it talks to the risk sentiment in the markets, and global risk premia are low. Lenders aren't fearful because global growth momentum from the US has given them comfort that default rates are unlikely. But that has fed into the valuations. And so with credit spreads where they are, with very little risk priced in, that's not something that would tempt us.
And then Dan, just I guess from a duration perspective, what opportunities is the market offering you at the moment, and what are your thoughts on that?
Yeah, it's a very, very timely question, not just in 2024, but the way 2025 has begun. And, we've clearly seen US Treasury yields rise quite materially over the last 3 or 4 months. Indeed, that's despite the Fed starting to cut interest rates. So that's very unusual. Changes in rates are typically a major driver of bond yields, certainly at the short end of the curve, but not so much this time. And that's not just true of the US, it's true of the UK as well. UK government yields have risen even more aggressively during the last 4 months. Not that it's as important an economy, of course. And that makes us more interested in lengthening the duration in the bond portfolio because the real yields on offer have risen. But of course, in order to get a more favorable price, there has to be a reason, right? It's not just a free lunch. And so clearly, I think what bond markets are saying is that there's a bit of concern about the potential inflationary effects of what Mr. Trump is offering. Clearly, he likes to boost and juice markets, and that's something he's well known for, and that could have inflationary consequences. But I think there's also a real issue about growing fears of US fiscal sustainability. We've talked a lot about the budget deficit in the US and how large that is relative to non-war, non-recessionary times at 6.5%. That's causing some concern. And if bond markets are becoming more sensitive to debt dynamics, then that could be dangerous for where yields eventually top out. But certainly they're offering better value than there were. And we feel that is a much more reasonable price to lengthen duration at.
Mm. Thanks, Dan. It's a very interesting topic of conversation for sure. Just turning to kind of China and Japan, it's very interesting because China's growth rate has been slowing in recent times, whereas let's say Japan is very clearly experiencing inflation now, which is very, very different to past expectations of the market over the last couple of years. What would you say has been the effect on their bonds, please?
Yeah, we have a chart there again to show the Chinese versus Japanese 30 years. So really a commentary on where the market feels that the respective economies are going to go over the long term. And for me, this is one of the most mind-blowing graphs of the year, because what we've seen is that Chinese yields have actually fallen below 30-year yields have actually fallen below the level of Japanese yields. And for so long that would have been almost incomprehensible, because we're used to China being the engine of growth for the global economy, 6% regularly, and if not 6, then near enough 5. And simultaneously, we've grown used to Japan being the victim of deflation and just not being able to kickstart its economy. So to have an indicator that's suggesting that Japanese prospects are brighter than Chinese ones from an economic standpoint, that really is something. Of course, the key issue here is that China seems to be at risk of deflation. CPI inflation is close to zero in China. PPI has been negative, so deflationary for a while. And that's obviously been driven to a large extent by the deflating of a property bubble that they've had. And, that's something that ironically, I think was responsible for Japan's, or partly responsible for a lot of Japan's problems over the last sort of 30 years. And so now we find ourselves in this situation where we're talking about the Japanification of China, ironically enough. And, that deflationary issue is clearly the big one. Weak domestic demand, low income growth, elevated leverage ratios, and particularly with real estate in mind, declining asset prices, and that's not good for Chinese consumer confidence, and that's really pivotal to changing the story here. What we have seen is that the Chinese authorities have attempted to signal that they're willing to intervene. So there were some measures there in Q3, Q4 of 2024, which is good in terms of showing their ability and intention to help. But I don't think anybody is under the illusion that those measures are enough by themselves to combat the deeply deflationary pressures that are seem to be really taking hold in that Chinese economy. So a real turnaround, a real role reversal there.
No, it really has been. And if you had to pull all of this together, then what would you say is your outlook for markets at this point?
So we do have an outlook slide. Some apologies there. It looks more like a disclaimer, but to try and sum up exactly what it means, I think we're trying to say that this is the type of environment that where investors will be best served by avoiding particular characteristics in the equity market. And we think those characteristics are the quickest way to put capital at risk. So we don't want to be investing in companies that are overvalued. High multiples, they demand to be constantly justified. So even meeting expectations is often not enough for those companies to sustain those elevated multiples. So that's a risky game we don't want to play. And we also think that the other key risk is investing in companies that are over leveraged. With bond markets telling us rates are likely to stay higher for longer, you really want balance sheet integrity, and that's going to be key to avoiding any of the worst of an equity market correction should it occur. So it is a safety first conservative approach, certainly on the equity side.
I think clients definitely do appreciate that. And Dan, I guess just the last question for today then is just about positioning of the portfolio. And if you can please share some of the details around that, please.
Yes, absolutely. Given my comments, it will be no surprise to hear that it is a defensive stance that we are maintaining, as you would expect, with the cautious sleeve of the fund offering. And how does that manifest itself? Well, we have a 20% equity weighting. So again, trying to avoid the pitfalls that may come with those overvalued and overleveraged stories in the equity market, and the low duration bond portfolio that allows us to avoid the worst damage caused by that rising yield environment. That's at the moment. As I said, the duration positioning will change as the value improves in the bond market. But I guess to conclude, we do have a very mature equity bull market. We have a bond market that no longer looks so confident about inflation having been defeated. So in short, we just think caution is advised.
Dan, thanks so much. It's always a pleasure having you join us. We look forward to chatting again soon.
I appreciate your time. Bye-bye.